Yeah, we've been joined here by Wale Oluwo, the Chief Executive Officer at BGL, Investment Banking at BGL Group. Thank you for joining us.
Thank you, Balaji. Good to be here again.
Looking at the state of the market today. But let me start from this Thanksgiving thing. What do you thank God for? Despite the crisis that we are seeing in the Eurozone, the various economies, Americans are saying, let's be thankful. Is that really anything to be thankful for?
No, we should be thankful that Nigeria is not substantially linked and connected to the global economy, such that while they are having this crisis, we could have been a worse experience for us. So we should be thankful for that.
Well, we don't have low inflation here. One of the things to be thankful for is that there's low inflation in the U.S. There's always treasuries. That's the backbone of the economy to back up any decision of the Fed Chief Ben Bernanke. And China has bullets, and that means investors especially spoke after the PMI data on Wednesday and showing that China's manufacturing sector is slowing. All right, let's take a look at the Euro market and see how it's been. We've got news at the stock exchange as planned, though that's has not been made official yet, to provide market makers, and each of the market makers will have at least 500 million naira to help boost liquidity and, of course, return some kind of confidence at the local bourse. What's your take on that? What's the reaction to this news and information?
Well, from my hand, I think this is something we should have done about 3-4 years ago. This market making initiative or market maker appointments have been on for more than 2 years. And I think at the time that it was proposed, these were part of the things that we expected would have helped the market to, moderate its unending slide at that time. Conceptually, I don't think it's a new concept. I think this is what has been happening in the global economy over the years. America is a very good model for this market maker regime kind of trading. And what it does is it deepens the market, because if you have a market maker, it imposes a responsibility based on the agreements that would have been signed with the stock exchange that they will pick some stocks, right? And anybody that wants to, buy those stocks, they'll sell to them, and vice versa. If you want to sell, they'll buy from you. So you have a market maker that makes market in the stocks, making sure that there's activity, making sure that there is depth, and making sure that the stock is liquid at all times. Now, there is a challenge, and the challenge is that we have market makers in the bond market. Okay, just before we go into licensed by the I was going to tell you
before going to the bond market,
how Nigerian system can turn a normal, a normal structure that should work based on economic fundamentals and then turn it on its head, and then you don't get the benefit of it. But I can't come back to that.
Okay, let's come back to that. Well, you mentioned that this market making policy, if I may call it that, ought to have been in existence in the past 4 years. But that's when we had the boom. 2007, 2008 was a period that many people made a lot of money. So was there any need for you to have market makers on board? How would you be able to, put them in? Because let me say, we already have the liquidity needed for the market, and so why do we have to
at that time, right?
At that time, so yes. How do they come in? How would they have come in at that time?
You see, their coming in was not really whether the market was booming or it was bearish. Their coming in was to complement a structure of the market that would drive an efficient market. That's what this thing was all about. So whether the market was booming or the market is bearish, it does not change anything. The structure is the structure. The trading platform is the trading platform. The stockbrokers will still continue to be there. And the market makers are also supposed to be participants in the market. Now, the stock market in the US had its own challenges, but market makers were still there. Let me tell you what is not good in a market system. A situation where people go to the market and everybody is buying the underlying stocks. Everybody is exposed. When the market goes down, it drags down everybody. That's part of the problem we have in the Nigerian market. The second problem that must never happen in the market is illiquidity. If someone has securities to sell, and then you get a stockbroker, and the stockbroker takes it to the market, and they come back to you to say, we can't get buyers for your stocks. There's no market. A market must set a price that clears itself. And I think this concept of market maker is going to help us over time to correct that anomaly where the stock exchange seems to have, given a band of 5% up or down.
Okay, maybe I should just come in at that point in time. The market maker is a broker-dealer, according to some of the reports we're getting, a broker-dealer firm that accepts the risk of holding a certain number of shares of a particular security in order to facilitate trading in that security. Now, each market maker competes for customer order flow by displaying buying and selling quotations for a guaranteed number of shares. Do you think this can be sustainable in the long term? Because if they do not get those to buy, they will have to pay for it.
That's the essence of market making. You are creating the market. There is something that must be fundamentally, explained there. A market can only determine either of price or demand. There is no market that cannot clear itself. But the problem you normally have is a seller wants to sell at 10 naira, a buyer is willing to buy at 5 naira. They can't make markets with such kind of divergence. But if you have a situation where the market maker can set his own price because he's buying the stock with his balance sheet, his own money, and he's going to sell at a price that is convenient for him. So if the market maker knows that there's someone who is ready to sell at 10 naira and there's another person who is ready to sell at 5 naira, he can come in between them and try to moderate the divergence in the market. That is what this thing is all about. But that is not really my concern. If we bring market makers here, it's fine. 500 million capital is not a bad idea, although it's not a lot of money too. Because
it's not a lot of money?
Yeah, absolutely so.
500 million naira. Because if you
in capital, it's not a lot of money. You know why? The market trades about 2 billion every day. So if a market maker is playing almost like 25% of the market, how many days can that last? But that is theoretical. What is important is that the market maker should also be in a position to leverage and be able to borrow from banks and other institutions in order to increase its size.
Well, I was just about to say that the NSC said it will work with the Central Bank of Nigeria to see how banks, financial institutions, can actually fund market makers. Would that be profitable for the banks? you have an experience in that area. Would that be profitable for the banks to say, I'm going to put in 2 billion naira, for instance, because 500 million naira is the lowest amount that is required? Would that be profitable to the banks, looking at the dynamics we have right now and the challenges of the market?
It may, because even now that the market is bearish, people are still making money. No matter the state of any market, there will still be people making money.
Selected stocks? Selected
stocks on one hand, but mind you, your loss, if you go to the market, if you had bought at 50 and you are selling at 20, someone else is making the gain. It's almost a zero-sum game. But what is important at this time is banks can fund the market based on those stocks that they may be interested in. But those days, banks would have been the major player in the market making system. But of course, now you are not likely to see them play that role because of the CBN new banking structure, where you say you must focus on your commercial banking and let the rest,
and so since
focus on investment banking.
They don't. Many of them have actually closed down the subsidiaries.
No, they are selling.
I know they're actually selling the subsidiaries, and so would that be good news for the markets, knowing that the arm of the bank that ought to have actually taken over the issue of market making may not be in existence, so the banks would have to now shift attention a bit to market making as regards that. And going by the various reforms of the Central Bank of Nigeria, the MPR being at 12%, you have to increase your cash reserve ratio, so you have little money, so to speak, to play around with. And even if you look at the interbank market, where banks lend to each other, it's been hitting a high of 17%, except of whenever we have allocations, inflow of liquidity from maturing bills and even federation allocation. That's the only time to see the numbers trending downward. But right now we're seeing everything moving up. So how can the banks really key into this market making without having to go, to have any challenges?
Let's put it this way, Balaji. Let's first agree that it is desirable to have market makers in our market. If we move from there, let us also agree that the challenges we are having now economically might not be there for the medium term to the long term, right? So even if you license market makers now, and they cannot make market as intensively as you would have wished, but they will still play in the market. Maybe as the money market gets better, more funds can find their way into the capital market. But structurally, let us institutionalize the market making regime first.